All right, so last week we started looking at changes in ownership. And I told you that changes in ownership occur in three ways. There can be increases because you buy shares. There can be decreases because you sell shares. Or there can be share issues. When the company issues shares, rights issues by the company, and the different shareholders take up shares in different proportion, then that can change your percentage. Yeah. And we started last week looking at increases, and this week we were going to look at decreases. Next week we were going to look at rights issues, and the week after that we were going to look at cash flows, isn't it? So we had this, and then we still were going to look at cash flows. So that email that came from UNISA basically, when we look at increases and decreases, if I had to draw it like on a timeline for you, we can go from having a 10% investment to having a 30%, which would be an associate maybe or a joint venture, to having 60%, which might be a subsidiary, to having 80%, which is still a subsidiary. Agreed? And when we looked at increases, which we looked at last week, we looked at when I buy shares and I go from, and last week we looked at two examples. We looked at when we went from an associate to a sub, and we looked at when we were a sub and we stayed a sub. Yeah. When we look at decreases, decreases work the other way. So decreases work this way. If I have 80% and I sell some shares, but I still have 60, so I still keep control, or I sell enough that I then lose control and I go from being a subsidiary to being an associate, or I lose so much control that I land up with just an investment, or I might even land up with nothing, isn't it? A complete disposal. But now it looks like what the TUT letter is that you got from UNISA, or the email that you got from UNISA, has basically said not to look at decreases, not to look at share issues, not to look at cash flows, and it basically, by the sections they've asked us to ignore, they've asked us to ignore these changes, isn't it? So they've asked us to ignore any changes where it's associates that become subsidiaries or investments that become subsidiaries, or the other way around, isn't it? And so it looks like, from what they've haven't said to ignore. Can you just read the beginning of that email for me? What does it say in the beginning, the first page of the email? Change in control of a subsidiary through buying and selling shares that results in a change in status. Change as a result of additional by means of rights issues. Okay. So what they've said is that they don't want you to deal with any change where there's a change in status. So change in status means that it's going from a sub to an associate, or an associate to a sub, or a sub to an investment, or an investment to a sub. They only want you to deal with changes in ownership where there's no change in status. In other words, we were a sub and we stay a sub. Yeah. But when we look at changes in ownership that have no change in status, we still are potentially looking at where it increases or where it decreases, isn't it? And last week we looked at where it increases. But the rules are the same. So let me just put that, just remind you of the rules, and we can look at it from the other perspective. So when there's a change in percentage, but no change in control, so in other words, it was a subsidiary and it stays a subsidiary, yeah? A change in percentage, no change in control. The rule is that it goes through, there's no goodwill, there's no profit or loss, and the rule is that it goes into statement of changes in equity. There's a new column that goes into that statement of changes in equity. That new column is called changes in ownership. And into that changes in ownership column will go the number which would have been goodwill or would have been or would have been a profit or loss on sale. The calculation of this amount is to take the fair value of assets and liabilities at the change date, to look at the percentage acquired or sold, and to then determine the fair value of assets and liabilities acquired or sold. To compare that with what was paid or received, and that would leave you with either goodwill or profit or loss. But we know that this goodwill, profit or loss, no, let me actually not even put goodwill, profit or loss. That will leave you with the number that goes into statement of changes in equity. This over here, just as a reminder, is also going to be the movement in NCI. Do you agree? Because what's happening when we have changes in ownership is that we are buying from NCI or we're selling to NCI. So this is the amount that NCI becomes bigger or smaller by. That's what we paid. That becomes statement of changes in equity. The journal entry, if I had to show you a journal, would be for an increase. For an increase, the entry would be to credit NCI because I'm making NCI smaller. Yeah. It would be to it's an increase, right? It would make NCI smaller. If I've bought more, I'm making NCI smaller. Bigger. Yeah, so it's a debit. I'm looking and thinking, this doesn't balance. NCI becomes smaller. I did say smaller, and then I said credit. Hey. NCI becomes smaller, debit NCI. My investment became bigger, so I've got to eliminate the extra piece of investment, yeah? Because I would have had two pieces of investment. The first piece I would have eliminated in my ONAC entry. The next piece I eliminate here. And then normally when I buy, I land up with goodwill. I pay extra. But that debit does not go to goodwill. It goes to statement of changes in equity. If it's a decrease, the entries are the other way around. So for a decrease, the entry is the other way around. Let me just see if I can make a bit of... see if I can move this a bit. So for a decrease, the entry is to debit my investment, because when I first did the elimination entry, I would have credited too much, isn't it? So because now the investment dropped, some of my investment's gone, so I've got to debit the investment. I've got to credit the NCI to make it bigger, and then usually here I would have had a profit, isn't it? Because I've sold shares, but I don't have profit. I have statement of changes in equity. Yeah. Last week we worked through an example which was an increase, because last week we were doing increases. And so now today we're going to look at an example which is a decrease, but again a decrease with no change in control, because that's the only one they want you to look at. And so we're going to look at this question 18, which I got out of that TUT letter 102. I don't know if you have it, but I've made some copies. Oh, is it? It doesn't have as many as last year. Okay, but check if one of those is a question called garage, or is it impossible to check? Let me have a look through while you look at that. Some more. Maybe they've actually already left out all the questions that you wouldn't have been able to do. Okay, yes. They've left out all the changes in ownership questions that they don't want you to obviously do. But this question, so thanks for printing that out because I can see exactly which one it is. This question in your TUT letter 102 is actually question 12. Okay, so you can change it in the handout that I've given you. So in TUT letter 102, it is actually question 12. The reason that the previous semester's TUT letter had many more questions is because it had all the questions on the rights issues and the associates becoming subsidiaries and the subsidiaries becoming associates. All right, so question 12, and presumably the one we did last week. We also did one last week from here, or not? Yeah. Must have been question 11. Yeah. Must be this question 11 now, I imagine. I don't know. Let me just see. Question 12 is a disposal in your study guides. Question 11.
This one was Lex and Next Limited.
We did Lex and Next. Yeah, no, this one is a company called Troy Zeus and Icarus. Yeah, it's just it's a piecemeal acquisition. We haven't done it, but that's what it is. So in TUT letter 102, question 11 is where we had. I can tell you from the percentages. We had 70 and now we've got 80. And this question, we had 80 and now we have 60. So this question 12, we have 80%, which becomes 60%. It's a disposal, but no change in control. Question 11, which if we have time at some stage we'll do, or you must go do, is a question where they had 70 and it became 80, I think it was. Let me just double check. I hate it when, and I just looked at it, isn't it? Yeah, they had 70 and 70 became 80, this one. So you can see none of them, neither one has a change in control, subsidiary, 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 but this one goes up and this one comes down. Yeah. All right, so we're going to have a look at this one today. So we see the trial balances, garage and workshop. We see that here's the investment in workshop. The investment in workshop is at fair value, 40,000 shares. And we see down here a mark-to-market reserve. Mark-to-market reserve. And the deferred tax on the mark-to-market reserve. So sometimes they do it like that, which makes it nice because you don't have to sit and work backwards, isn't it? So if they say it's the deferred tax only on the mark-to-market, then you know that you can just take the two numbers together and you can see what the increase was in fair value. You'll see also on the face here, they have this thing called proceeds on the sale of 10,000 shares. So it looks like they haven't accounted for it, isn't it? It's horrible when they do it like that. But what this means is that the journal entry that they've already passed must have just been a debit to bank when they received the money, isn't it? And a credit to this account, to this proceeds account. But they haven't actually done any accounting with it. They haven't worked out a profit. They've done nothing. Okay. Okay, so debit bank, credit proceeds is the entry that they've passed here. All right, so additional information. Garage acquired control of workshop and acquired 40,000 shares on the 1st of March 11 when the retained earnings was 28,000 Rand. What's our year end? February 14. 28 February 14. Okay, so March 11 was the first acquisition. The fair value of the assets needs to be adjusted, a building and a receivable. Remember, buildings would have been depreciated or maybe not. Receivables needs to flip the next year. Yeah. On the 28th of February 14, that's year end. Is it year end? They sold 10,000 shares to the non-controlling shareholders. They still control the company. Goodwill was not considered to be impaired at year end. The group elected to measure NCI at partial goodwill method. Garage measures its investments at fair value through OCI. The fair value is considered to be equal to cost unless otherwise stated. They did state otherwise. Prepare the following: statement of financial position, statement of P&L, statement of changes in equity. So you can just set those up for me. That would be your first step from what you were given, the trial balances. You set up a quick SFP, P&L, and statement of changes in equity. Marks will be not be allocated for that. There's no total column required. Share capital, changes, retained earnings, NCI. Remember the timeline. March 11, 1 March 11, Feb 13, Feb 14. If we look at what those dates are, this is beginning of year, this is end of year. Then if we look at the other dates, this is acquisition, 40,000 shares. And then over here we have a disposal, 10,000 shares. There's no change in control. They did say to you in the question, but you could also, you need to go and work out the percentages. And then we know that because that disposal happened right at the end there, the NCI percentages will stay the same, isn't it, for the whole period? Okay. So this is the calculation you need to do. You need to do an ONAC, then you need to do a movement to beginning, you need to do a current year, and then you need to do a disposal. Okay. I'm going to give it a try. Can we have a look? All right, let's start off with the timeline. Oh, back here. So acquisition, first acquisition, 1 March 11, we acquired 40,000 shares. It was 80%. Yeah, 40 out of 50. Share capital 50, retained earnings 28. There was a building that needed to be adjusted up by 10. Tax on the building down by 2.8. Be careful there, only land is CGT. Or from FAC3704 investment buildings, isn't it, above cost. But it has to be the above cost piece, not the above carrying amount piece, yeah? But normally we don't see that overlap here. So just land would be CGT, building is 28%. And then the receivable down and the deferred tax on that, the other way. Tax is always the opposite. 81.6, NCI 20%, 1632, leaving me with 65.28. I paid 65.24 because there was a 10 of fair value that needed to be reversed. Yes, we're all nodding. I got a bargain of 40,000 or 40. Yeah, 40 rand actually. 40 rand. Right, then from acquisition to beginning of year, retained earnings moves by 47, from 28 to 40 to 75. Yeah, retained earnings 28 becomes retained earnings 75, moves by 47. There's this receivable that needs to roll in the very next year, always, yeah, because it would have been recovered within 12 months. It was current, so I had written it down. So if they hadn't collected it and had written it off as a bad debt, they're double counting it, isn't it? So we need to reverse that. So I'd written it down, I reverse it, it goes to retained earnings at the net amount, 3.6. So that was a down, this becomes a plus, the minus becomes a plus. 50.6 is retained earnings since acquisition. NCI gets 20%, they get 10, 120. Current year profit, they gave you profit before tax, and tax was 55. NCI gets 20% of that, they get 11. And at end of year, there was no dividend, but there was a disposal of 10,000 shares, which works out to 20%. Share capital at the end of year was 50. Retained earnings at beginning was 75 plus the profit for the year of 55. I'm doing the same calc that I did there, I do here to determine fair value of assets and liabilities. Presumably that building is still there and it's still worth that. They didn't say that it had been written down. They didn't say that the subsidiary had accounted for it subsequently. So we put it back in again, building and the deferred tax, giving me net asset value 187,200. I sold 20%, 3744. I sold it for 55. So therefore I made a profit of 17,560. Because I didn't have a change in control, that profit goes to statement of changes in equity, 17,560. Then looking at the numbers that need to come out of here for my calcs. NCI is a number of things. Let me do it in green. So NCI starts on AC 1632. Since acquisition to beginning of year, plus 10,120. Current year share of profit, plus 11. If there was a dividend, just be careful with the dividend at your end. If the dividend was at your end, it might have been declared after the disposal. Then they would have got 40% of the dividend, not 20%, but no dividend. And then we sold them some shares, isn't it? So they grow. So their balance grows by this 37,440. So NCI, beginning, movement to beginning of year, they get a share. Current year profit, they get a share. No dividend to reduce their balance. But then we did sell them some shares, so they get a bigger share. So that's the 74,860. Is all of those numbers. Then retained earnings at beginning of year. I'm just looking at the subsidiary for now from these numbers. So retained earnings at beginning of year for the sub is the 50.6, yeah, less the 10,120 because that bit belongs to NCI, plus the 40 Rand bargain gives me the 4520 retained earnings at beginning of year. To that, I will just add the parent and I will have the number for statement of changes in equity. There's just one more thing which I see they did. It was funny, a funny thing in the solution that they did, which I think I would have forgotten to do. But you know when they told you here that they have this thing, proceeds on sale of shares, and I said to you that it's because they haven't accounted for it yet. All they've done is pass an entry, which is debit bank credit proceeds. The entry should have been debit bank credit investment credit profit on sale. Do you agree? And they didn't put that through. Actually, it doesn't go to profit on sale because what it is it goes, this investment is being carried at fair value through OCI, isn't it? Because it's going into the market reserve. Yeah. So when we carry an investment at fair value through OCI, it doesn't ever, this profit on sale actually lands up in OCI. Yeah, it never lands up in P&L. All we would do at your end is we would just look at what the balance should be for the shares that are remaining, and then the difference we would just flow through OCI. Yeah. So this proceeds of 55 should have flown through OCI and would have resulted on cost on a profit of 38,690. Yeah. How do I get that 38,690? In the company's books, if the company was carrying this investment at cost, it would be 65,240. Do you agree? We sold 10 of the 40 shares. Or you can say we sold 20% of the 80% we owned. That calculation has to be sold over old. Yeah? Sold over old. What did I sell? What did I have before? I had 80%, I sold 20. I had 40,000 shares, I sold 10. We do that calc and we multiply it. I'm multiplying here by the cost, 65,240. And the reason I'm doing that is because I want to work out how much tax I have to pay. Because do you agree that in the company's books, the company sold an investment above cost? They have to pay capital gains tax on that, isn't it? So they have to put that entry in the books for the tax. And so the cost was 65,240. If I do sold over old, I land up with this being the number, 16,310. So an investment which I was carrying at 16,310, I've sold for 55,000. So I've made a capital profit of 38,690. On that, I have to work out capital gains tax. 7215. I think I would have forgotten to do that in the exam, perhaps. 7215. Okay, I think that what they didn't want to do is put it in the mark to market, adjust the mark to market, and confuse you with it. So that's why they left it there like that. But when you get to honors, obviously you need to be able to work through what happened in the company, what's where, so that you can back it all out, isn't it? We're backing everything out to cost. So essentially our first journal entry would have been to back out the 8 and the 1 against the 75. Do you agree? We would have landed on 65. Yeah, and then to say, okay, if I've landed on 65, what is profit on that and what is tax? All right, so be careful with where those numbers are then, because remember, we've got to take out what happened in the company, because that's not what happened in group. In company, they may be showing a profit on sale of an investment. It may be in OCI, it may be in P&L, depending what kind of investment it was, how it was being carried. But for group, we don't want anything in P&L or OCI. We want it to be in changes in equity, isn't it? Changes in ownership. So this is the solution then. The statement of financial position was a very straightforward statement of financial position. There's just a couple of things, adjustments. The first is this 10 on the PPE, yeah, which came from your ONAC. So the 10, let me actually see. Okay, I suppose I can show it like that. The 10 on the PPE, which came from the ONAC, and then there's let me just make it fatter. So there's a 10 on the PPE, which makes PPE bigger, and then the tax on that, the 2.8, lands up down there, yeah, because we would have reversed the mark-to-market tax and been left with no deferred tax. And then the only other adjustment that you see on here, which you wouldn't have seen, is the 7215, which is the tax on the profit on the disposal of the shares. Yeah. These three numbers, share capital, owner's equity, other components of equity and retained earnings, these three, we're going to look at them in the statement of changes in equity. Okay. So otherwise, everything else was just add. Do you agree? Okay. Then, income statement. The only adjustment here, again, was this 7215, the tax, which was the capital gains tax, and then the 11, which we had calculated, which is NCI's share of the profit for the year. Yeah. Consolidated statement of changes in equity. NCI starts off at 26,440, which is the ONAC plus the 10. Yeah. So if I go back to my calc, I should have maybe just done a beginning of your NCI. No. Here. So the opening NCI is these two numbers, 16,320 and 10,120, which is 26,440. Yeah, 26,440, which should be what this NCI number here is, 26,440. Retained earnings at beginning of year, we had worked out a 40-something number, isn't it? So it's the 110, which is the parent, and we had worked out this number here, 4520, isn't it? We had worked out. Is it what we worked out? Should have just double shown it. 4520, yeah. So 4520 plus the 110, which is the parent, gives you this 150,520 over there, which is just purely the parent plus our 40,520 that we had worked out. Share capital stays the same, and they've put in some total columns which we don't need. Then what do we see coming through? We see the 11 and this, which comes from the P&L. And then we see this, the change in ownership, 17,560, which is profit, so it's a credit going up. NCI going up by the 37,440, and that balances to the 55, which is what we have to account for, isn't it? The total of the 55, which in our balance sheet then would have been in bank. Yeah. yeah, and those are the three things that they ask you to do. I wanted to show you what the analysis looks like. When we have changes in ownership, the analysis takes on some like extra dimension down here, which starts to like get a bit confusing, like where the numbers are coming from and where it's balancing to, isn't it? And you see that what they also do with that is that they put like a bargain purchase up there, then they remove it here because we want our numbers to be excluding the bargain purchase, isn't it, in that column, which is the share capital, the on acquisition column. So yeah, it does some funny things over here, yeah, where we land up with this 21,120 that we're reversing out of retained earnings. But I don't know, it's just a funny calc. And I mean, this is a simple one because this is a no change in ownership one. When we have changes in ownership or rights issues, it can get really like ugly here. This one was also one that happened at the end of the year. So if it had happened in the middle, we would have had to have profit for the 6 months, then the change, then the profit for the other 6 months. And if there had been intercompany transactions, you can see this calc gets bigger and bigger and bigger, isn't it? So while initially and maybe at second year level, it looks like it's not a difficult calc to do, when you start to get into complicated consolidations, you spend so much time trying to get this calc right that you lose the focus on what you're actually having to do, which is to prepare those financials, isn't it? I had a colleague who lectured here for a while, and he said to me once that he never did work out NCI when he wrote his exams, and he's a qualified CA. But he said that he always realized that he would always get it wrong, and it would take so much work to get it done. So he would just do everything else. He would do everything else, you know, all the intercompany stuff, all the like basics where you have to add, all the simple eliminations and all of that. And he said he would always just leave out the NCI. And yeah, I suppose it's called exam technique, that, isn't it? Which is to say, it's not that I don't know how to do it, it's just that it takes long to do, and I'll make mistakes, and so therefore the marks that I'm going to lose, I'd rather just lose there because I might have lost them anyway, because the numbers might have been wrong anyway. But NCI can be a lot of marks, hey, because it's a lot of calcs to get to the number. So that's the main purpose of doing this analysis, is to get the retained earnings and NCI numbers, isn't it? So here they are at the end, here they were at the beginning. There's the 4520 that we worked out, and the 26440, and there's the 74880 that we had at the end, isn't it? So there's the numbers, the end numbers. So that's the purpose of doing it. If you can do it in a different way, a quicker way, then it's beneficial. So that's the change in ownership question. The other one that I had, here are the journals. So here, yeah, the journals are not theoretically correct either. You know, when you do, I see they do a thing where they're putting the profit on the sale of the shares into the P&L, but these shares, if they were carried at fair value OCI, once you've chosen OCI, you can't then choose P&L, then it's always in OCI, and the only thing you can do is a transfer in statement of changes in equity from to retained earnings, yeah, not through P&L. So that's not theoretically correct, but that's the same journal that I sort of had done, yeah. So this is in the books of the parent. In the books of the parent, do that. There they're doing the realizing of the mark-to-market reserve, of the existing piece of the reserve, and then they do tax. So the reserve that existed, do you agree, which was this? 8135. They're saying 20 over 80, sold over old, of that is realized because that piece of investment is sold. So they're just moving it out of the mark-to-market, or they're putting it into the investment. I don't know, it's weird. The way that you do it when you realize is you take it out of mark-to-market into retained earnings is the way it's supposed to happen. Okay, but here's your pro forma consolidation entries. Journal 1, reverse the mark-to-market. Journal 2, record the adjustments on AC, but I like to just put that into that one, isn't it? So I do 2 and 3 together. There's your first on AC journal, resulting in the bargain. Then we give NCI their share of retained earnings since acquisition, the 10,120, which adjusted for that receivable. Then we give them their share of the current year's profit, and then we have the change in ownership journal. So the change in ownership journal reduces the investment, removes the profit on the sale of the shares, and then goes to NCI and to change in ownership. And that's that one. Deferred tax, they're just showing you how the deferred tax balanced. But everything that went in basically came out, and we were just left with the building deferred tax. Yeah. Okay. All right, so then the other thing that I wanted to do today was this example 6.2, which is when the subsidiary becomes an associate. When we do disposals, if I just go back to the very beginning, when we do disposals of or decreases in ownership, there are actually 4 calculations that you need to do. It's quite a complicated thing. So you'll be learning to do them, I suppose, when you get to honours, isn't it? So it's just something that you must remind the lecturer that you do honours with, that when you did FAC3704, that they removed this from the syllabus. So you haven't actually dealt with any changes in ownership other than where there's no change in control. Because they need to know that they need to teach it to you from like scratch, because otherwise they'll just assume prior knowledge and then just dive in and do the more complicated changes that can occur. When you think about changes I've given you, the ones I've given you even here are simplistic, because there can be changes from joint ventures and joint ops, isn't it? Also between joint ops and joint ventures and associates and subsidiaries. So there can also be extra changes sort of in between here with joint ventures and joint operations, which I haven't even put on the board. Which at third year level we never did do the ones with the joint ventures and joint ops, but obviously at honours level you do. At honours level you can get any kind of change in ownership and you need to be able to deal with it. Right, so that's changes in ownership. The bits that we have to do is fairly straightforward, right? No change in control, goes into statement of changes in equity, and all we need to do is work out a calculation of fair value of assets and liabilities at that date, what percentage we bought or sold, work out what that was, what we paid or received. The difference goes to statement of changes in equity. The change in fair value goes to NCI, and it will either make NCI bigger or make NCI smaller. Yeah. When your investment is carried at fair value, everything goes back to cost first, and then you fix. Okay. All right. So that's today's lecture. So I was kind of thinking we have a whole lot of other stuff to do, but we don't. Let me just do a time check. Maybe you can go and do that question 11. You want to give that one a try? That one we haven't done, isn't it? Because you said we hadn't done it, that question 11. So let me just pull it up. You don't have it? No. This whole thing is going to affect like all the past papers that we're able to do as well. Because just about in every past paper there would be a question that would be a change in ownership, and we might not be able to do it. Okay. Okay, let's have a look at the workings. I'm just going to work through it here. When you first did your ONAC, you landed up with a 15 goodwill, is that right? I'm not getting that to 214. 112. 214. One two two 140. What is the retained earnings? 682 straight. Yeah. Share capital 400. Yeah. Profit 40, 640. 140. Yeah, less. I was taking 66 off. So this is 14. Yeah. So my numbers were not coming out right. 40 point. 14. So then that's a 14, 682. And that's a 214. And then that's a 214 at the bottom. Okay, so first acquisition of Icarus, goodwill of 15. They tell you somewhere about goodwill being impaired, do they not? Or do they say it's not impaired? It's impaired by 5, so the goodwill on the face will then be 10. Yeah. And then second acquisition happened in the current year. Share capital, retained earnings at beginning, profit for 3 months. Yeah. 3 months of profit, 4140. Is it 4140 or 4140, giving you a net asset value of 1122,140. 10%, 112.214. We paid 110, so there's a gain there of 2214. NCI would then be what it was at the beginning, less what we now purchased from them, isn't it? So the NCI drops. When you do NCI share of profit on this 4140, they get a 30% share. On the rest of it, they only get a 20% share, yeah, because of the way that the percentages work. So if we just have a look at the statement of at the analysis, which is their workings, they start with the 15 goodwill at the beginning. Then there's retained earnings since acquisition of 532, of which we get 30, they get 20. No, we had 70, they get 30. 70, 30. Then the first 3 months of profit, 4140, we get 70, they get 30. Yeah. Leaving them with a balance then of 336 and us with a balance of 400. Then we purchased an extra 10%, 112214. You see what they have to do here is they have to take this number, then they have to adjust it for that goodwill which they've added on, to remove it, to land with that number, to then times by the 10%, right? But we would have done a calc, we would have done another calc at that stage. To get to the 112, we paid 110, so we have change in ownership of 2214. The NCI drops by the 112214 because we bought shares from them. Then we land on that. Then for the remaining period, the profit is now shared in the 80-20 split. 80-20, and the dividends are shared in the 80-20 split. So retained earnings beginning of year for the subsidiary is this number, 48834, and for the subsidiary, it's the for the NCI, the NCI balance is 244. No, that's not beginning, that's end. But that's the number we needed because we just were doing a balance sheet. Yeah. So we were only doing a financial position, so those are the numbers that we would need to add to parent. We also in this case had an associate. So to actually get the retained earnings number, you had to look at the associates as well. I don't know if you had time to do that. It was a fairly big question. Where's my calc for the associate? You know that when we have associates, we always must check for a bargain, isn't it? That's the only reason we do it in the beginning, is to check for a bargain. If there is a bargain, it affects retained earnings and it affects the carrying amount of the investment. So when we did the acquisition or the ONAC for Troy, which is the associate, we did land up, in fact, with a big bargain, 45.750. So share capital, retained earnings. The acquisition was the first day of the year. Share capital, retained earnings, we land up with a big bargain of 45,750. It would have gone into retained earnings. No, it would have gone into share of profit in associate. Yeah. So I always say, it goes to retained earnings. No, it's current year. It goes into share of profit in associate. Share of profit in associate. So the retained earnings number is the parent, what we worked out for the sub, and it is what went into share of profit in associate, isn't it? Although there was also an intercompany at some point. I don't know if you got to all that. But what I wanted you to see was the change in ownership piece. Yeah, the calcs that we do for the change in ownership. We do a first acquisition to work out if there's goodwill or bargain, and we do a second acquisition. In the second acquisition, whatever we get there does not affect goodwill, does not affect bargain, isn't it? So although here this looks like goodwill and bargain, this goes to statement of changes in equity. Even if this was more goodwill, it goes to statement of changes in equity. That goodwill does not get affected, isn't it? It's just that one. Okay. So what you'll see is that when you do this at honors level, If NCI is carried at full goodwill method, we will give some of this goodwill to them. We'll take it and give it to them, and we'll show a smaller profit, because we'll show that we gave some of our goodwill to them, as well as net asset value to them. So we actually made a smaller gain or a bigger loss or whatever it is. And because we're giving them some of the goodwill stays the same on the balance sheet, but the split between NCI and profit changes, isn't it? But I don't think we see that at this level. But we're going to work through whatever questions we can find, isn't it? So in that study pack, Tat Letter 102, these are the two questions for the change in ownership, an up and a down. No change in control. As I said, when we start to work through past papers, I don't know what they're going to say when they send you the past papers. They maybe will just leave out all those questions, isn't it? We're pretty much going to be leaving out just about a question a paper almost. And unless there's a question that's just a simple no control change. There, I think, are a couple of those, but the big questions are the ones where it's an associate for half a year and a subsidiary for half a year, isn't it? Which we saw last week, which you don't need to know, it looks like. All right, so from next week then, we'll start going through past exam papers. The first one we're going to do is the one that was just written. Yeah, we're going to work backwards. So we're going to start next week with the October 15 one. It should be on my UNISA. I'll also check and I'll print it if it is. I'm sure there won't be solutions. I would be surprised if there are solutions, but I'll also have a look. Sometimes they put things in all sneaky places. Sometimes you see them in an announcement, isn't it, with an attachment. So it won't be in the official material, it's in an announcement. Sometimes it's in that additional material. So you have to look in all the places and not assume that, I don't know why they don't just issue a Tat letter, isn't it? I think it's so that way they don't have to print it, or I don't know. So, yeah, we're going to start with October 15 and see what's there. If there's cash flows there, we won't be able to do that. If there's any major changes in ownership, we won't be able to do it, but we'll be able to do the rest. And we'll just keep working backwards like that. So we'll go October, then backwards. I'm hoping that I do have, obviously, a pack of questions with solutions, and that's the only solution that I don't have. Yeah, so I have questions and solutions going back, I don't know, the first one that I see here when I open my file is May 04. But we're not going to go back to May 04, right? We're going to start working backwards. And then if you ever at a point where you want more questions to do, just shout. I've got going back for quite long. And some things, I'm just trying to think what would have changed. Yeah, I think they introduced the fair value, NCI at fair value. But if the questions that I have that are old say NCI is at proportionate net asset value, then you know that that's what it is, isn't it? You just won't see that fair value piece. So, but otherwise, I think groups as principles, nothing much has changed. Okay. If you get any other emails, let me know. But so far, it's almost like they maybe had been planning this for a while, isn't it? Because they even went and changed Tat Letter 102. And when was that first on the... Is it new?
Yeah, I got it about 2 weeks ago.
Oh, okay, so it's also fairly new. So it hasn't been available on my UNISA from the beginning.